Everyone is talking about the housing market. Home prices keep going up, people are buying homes left and right, and interest rates keep coming down. But in the back of everyone's mind are memories of the 2008 crash when real estate prices collapsed because people are worried that's going to happen again. What's up everybody, I am Jaspreet Singh from theminorityMindset.com and welcome to The Minority Mindset. Now before we jump into today's video about the real estate market and the housing market, I do want to let you know that I already recorded a video on my thoughts of whether we're going to see a real estate crash in 2021. So if you haven't seen that video yet, I will link it for you in the description below. I want to expand on the video though because lots of people in the comment section have been asking about why real estate prices haven't crashed yet and what exactly is going on in the housing market right now. We're hitting this kind of weird inflection point in the real estate market right now because home prices keep breaking record highs, but now we're starting to see mortgage applications start to drop. Some people naturally are already jumping to the conclusion that this is the end of the real estate bubble and now real estate prices are going to crash, so buckle your seatbelts. But it's really not that simple. Now, of course, I can't predict the future. I mean, I'm just a random guy on YouTube. Everything I talk about in our videos kind of comes from my own personal opinions and from my own experience in real estate because I am a real estate investor and I also have a real estate salesperson license. I don't actively use my license to help other people buy and sell homes anymore, but I keep my license that way I can help find my own deals. Let me start here. We're starting to see a little bit of a dip in mortgage applications, which means we're seeing less people going out and buying homes. But this isn't something to really lose your minds over yet because, well, it's the winter time and less people naturally want to move and buy a home and sell their home during the winter time during the holidays because this is the time that people just want to be home and spend time with family. Plus, cases of this pandemic are shooting back up, so people are not wanting to buy a home right now. We have talks of a vaccine coming very soon, so you have to imagine that some people are thinking, you know what, maybe I'll wait to buy a home until this vaccine comes out, so I'll just put my home buying process on hold for a few months. Let's dissect the anatomy of a real estate crash that we understand what a real estate crash is and what could potentially cause it. So a real estate crash, when people talk about a housing market crash, is when you see a 20% drop in home prices. So if your home is worth $100,000 and its value drops to $80,000, that is something that I would consider a real estate crash. When you see home values drop 10%, that's considered more of a correction, but when you see a 20% drop or bigger, that's more of a crash. For home prices to crash by 20% or more, you need the supply of homes for sale to go up and the demand to buy a home go down. So that means you have to have people selling a home, but you don't have buyers actually buying these homes. An example of this would be, I think my home is worth $100,000, but every house on my block is listed for sale. So now I list my home for $100,000 and no buyers are making me an offer. So now I have to reduce the price of my home from $100,000 to $80,000 to get an offer on my home because every seller is trying to compete against each other to get a buyer. For this shift in the housing market to happen, you have to look at 4 different things: jobs, wages, interest rates, and what I call the X factor. I'm going to be talking about all 4 of these things. What I was kind of hinting at a second ago is that the value of any asset, real estate, stocks, it doesn't matter. The value of any asset depends on supply and demand because the price of your asset, the real value of your asset, is not what you think it's worth, it's what someone else is willing to pay for it. You might think your home is worth $100,000 and that might be the fair market value of your home. But if no one's willing to pay more than $65,000, then is your home really worth $100,000? No, it's worth what someone else is willing to pay for it. The value of your home can change with time. Like maybe you spent $200,000 building this home, that was the cost of the materials and labor, and you think your home is worth $100,000, but if you're in the middle of a recession and nobody has jobs and they can't afford your home, then right now, maybe your home is only worth $65,000 because that's what someone else is willing to pay, but that doesn't mean that's what your home is going to be worth forever. This might sound really negative, but it goes both ways because now if you think your home is worth $100,000 and let's say you're in a booming economy now and you list your home for sale and then a week later you get a dozen different offers from people willing to buy your home and you have people bidding above your asking price, so now you have people willing to pay you $130,000 for your home that you thought was worth $100,000, are you going to say, oh, thank you so much for this offer, but you keep that extra $30,000, just pay me $100,000 because that's what I think a home is worth? No, you're going to say, going once, going twice, going 3 times, sold to the person who pays me the most money for this home. So the price of any asset depends on supply and demand. When you have more buyers than sellers, so when you have a lot of demand and a limited supply of homes, this is going to push the price of real estate up because now buyers are going to be fighting against each other to buy a home and this pushes home prices up. When you have more supply than demand, so now you have everybody selling a home. Now the sellers are going to be fighting each other to get a buyer, which means sellers are going to be cutting the prices of their homes to get a buyer. I erased the title so I can show you this, but every asset class kind of follows a similar cycle where you have periods of home prices or assets going up, and then you have periods of this asset class going down. So booms and busts. This is what happens in every asset class. 2008 was a bit of kind of like an outlier because it wasn't your normal 10-20% drop. It was a full-out collapse with no activity happening in real estate whatsoever. So what you saw happen in 2008 was not a normal boom and bust that you see happen in asset classes. It was a full-out collapse. Typically, you see these smaller kind of increases and decreases in prices of assets. You see this happen in real estate, you see it happen in the stock market, it happens in every asset class. So these booms and busts in real estate, this number one, right? You can see it happen in these cycles. The reason these booms and busts happen is when you see the shift in supply and demand in real estate. Now, the reason why you see the shift in supply and demand is because of jobs, it's because of wages, it's because of interest rates, and it's because of this X factor. These are the four things that I'm about to talk about right now. But before I do that, I need you to do me a quick favor and smash that thumbs up button below, because the way the YouTube algorithm works, if you do not smash that thumbs up button, then YouTube is much less likely to show you and other people our financial news and education videos. Let's start by looking at jobs. Jobs are the first indicator you want to look at when you're looking at home prices and real estate, because if people don't have jobs, then they're not going to be able to get qualified to get a mortgage to buy a home, and they're not going to be able to afford their housing payments. If jobs are not readily available, then people are not going to have incomes. If people don't have incomes, they're not going to be creditworthy, and if they're not creditworthy, they're not going to be able to get a mortgage, and if they can't get a mortgage, for the vast majority of people, they're not going to be able to afford a home, which means now the demand side of real estate is going to be hurt, because if people don't have jobs, they can't buy homes, so you have less buyers. That's going to hurt the demand side of things. On the flip side, if you own a home and you have a mortgage payment and you lose your job, now you don't have money to make a mortgage payment, which means now you might be forced to sell your home, or you might be forced into foreclosure, which both affect the supply side of real estate, because if people don't have jobs, then you will see the supply of real estate go up, either because you'll see more foreclosures or people will be forced to sell their homes. Let me put this in perspective. In 2008, the highest unemployment rate that we saw was 8.4%, and the average unemployment rate in the United States for the entire year was 5.8%. If we compare those 2008 numbers to what we're seeing in 2020 and going into 2021, the Department of Commerce reported that our unemployment rate has come down to 6.9%, and this is as of November of 2020. Lots of economists are really happy when they heard the 6.9% unemployment number, because that means more people are getting jobs. But if you compare that to 2008, it's not as bad as the worst number that we saw in 2008, but 6.9% unemployment is still way worse than the average unemployment that we saw in 2008. So 6.9% unemployment is still really bad, but a lot of this has to do because of the pandemic. So it's hard to say what the unemployment number is going to be and how many jobs come back once this pandemic is over. I'm sure it'll be better than what it is right now, but this is definitely something you want to pay attention to. Just think about it practically. If people don't have jobs for a really long time, it's going to be hard for them to qualify for a mortgage, which is going to make it hard for them to buy a home, which could affect the demand side of real estate, because that could hurt how many people can buy a home. Plus, if people don't have jobs, that's going to hurt the supply side of things, because if you don't have an income, you can't make your monthly mortgage payment. And if you're not making a monthly mortgage payment, your bank might foreclose on you. And if your bank forecloses on you, then you're going to see an increase in the supply of homes. Now, I know this is kind of like a weird time, because we have this mortgage forbearance program going on, where if you can't make your mortgage payments, then you can enter into this forbearance program, which allows you to defer your monthly mortgage payments. But I'm going to save this topic for later in the video. I'll just leave you with this right now. 3.6 million households in America are in forbearance as of October. That's 3.6 million families that are not making their mortgage payments. You're going to see why this matters in just a minute when I get to the X factor. Moving right along, wages affect the affordability of homes. I briefly mentioned this in a previous video, which is why if you haven't subscribed to our YouTube channel, you should do that. But real estate is very different than the stock market, because affordability of homes is very, very important in the real estate market, but it's not as important in the stock market. Like in the stock market, you can have a stock price go like this. I mean, you can have stock prices that shoot straight up. You remember what happened to Tesla and other stocks that even were bankrupt. You saw stock prices shoot up with no fundamentals or reasons why they're shooting up. This can happen in the stock market because the affordability of a stock isn't very important. I mean, if a stock becomes not affordable, a company can do a stock split and you can just buy fractional shares of stocks thanks to technology. In real estate, you can't do that. You're not buying fractional shares of homes to live in, right? You're not just gonna buy the front door or a window, you need to buy the entire home. So the affordability of a home is very important when it comes to home values, because if homes are too expensive, people are not gonna be able to afford a home. This is why it's important to look at wages, because if you see people's salaries and wages go up like this, then you're not gonna wanna see home prices move like this. Because if home prices are growing a whole lot faster than what wages are, you're going to create this gap in real estate where now people cannot afford to buy a home because home prices are growing way faster than what wages are. If the cost to own a home, so now we're looking at home prices and interest rates, if the cost to own a home is significantly growing faster than what wages are, you're going to see one of two things happen. Either housing prices are going to have to correct so people have the ability to afford a home, or you're going to have to see wages go up to make up for this kind of gap. One indicator that a lot of real estate experts like to look at is how many first-time home buyers are buying a home. In any given healthy market, first-time home buyers are typically making up something like a third of all home buyers in the entire real estate market. But the interesting thing is that in 2020, we're seeing some of the lowest levels of first-time home buyers since the 80s. What this is kind of hinting at is that homes are becoming less affordable, which is really not that unexpected because we've seen home prices go up by something like 14% in 2020 alone. When the Federal Reserve Bank slashed interest rates early in 2020, once this pandemic first hit, we saw this huge wave of home buyers entering the market, and this new wave of people trying to capitalize on these low interest rates pushed home prices up, and so we're seeing home prices grow way faster than wages. What makes this even more interesting right now is that the supply of homes in 2020 is limited because we have this forbearance program going on where if people cannot afford their mortgage payments, they're not getting foreclosed on because this government program is out there and it's preventing foreclosures from happening. So you have a limited supply and you have all these people trying to take advantage of low interest rates, which has pushed the price of real estate up. Now, I'm going to talk more about this when I get to the X factor part, so you'll see why this matters again. Now, before you can come in and say that real estate prices have to crash to make up for this affordability gap, I want you to hold that thought because I'm going to come back to that when I get to the X factor. Now, let's get into the juicy stuff. Interest rates, because I know a lot of you are having dreams and nightmares about the interest rate environment that we're in. Or maybe that's just me. I don't know. But interest rates affect the affordability of homes, and they also affect the affordability of refinancing homes. A general rule that you need to understand about interest rates is that as interest rates go down, more people typically are buying homes, which pushes home prices up. In general, when you see a sudden 1% drop in interest rates, you'll see something like an 11% increase in home prices. The reason why this is important is because let's say you want to buy this lopsided house, okay? And if this home is on sale for $500,000 and you want to buy it with 20% down, and let's say the interest rates at the time are 5%. If you buy this, your monthly payments on this $500,000 home are going to be $2,147. So this is the amount of money you have to pay on your $400,000 that you borrowed, because remember you put 20% down. But if interest rates were not 5%, let's assume now that they were 2.9%, now you're not going to be paying $2,147 a month, you're going to be paying $1,665 a month now. So you're going to be saving a ton of money on your housing payments, assuming you put the same 20% down, assuming you have the same 30-year mortgage, assuming you're buying the same lopsided house, all because interest rates are cheaper. Over the course of your 30-year mortgage, you would save $175,000 on this same lopsided home if you were able to get a 2.9% interest rate than if you had to pay 5% interest. So interest rates are very important because they affect the affordability of homes, because if you have to pay higher interest rates, your monthly payments are going to be higher. This is where things really start to tie together, because now if a home is not affordable, because like we talked about in the wages section, if home prices go up faster than wages and people can't afford a home, one thing that you can do is cut interest rates, because now if interest rates are cut, then homes can become more affordable, at least for the short term, because then people will be able to have a lower monthly payment on the same home. Likewise, if your wages go down, maybe you lose an income stream in your house, or maybe you get your wages cut, whatever, and if interest rates come down, then you can refinance your mortgage and have a more affordable monthly mortgage payment even though your wages come down. So interest rates can kind of balance out lower wages, or they can balance out this job issue. But it all kind of has to happen in harmony, because if you keep cutting interest rates, then home prices are also just going to keep going up. You can also compare that to the opposite if interest rates go up, because now if interest rates go up, now your monthly payments are going to become a little bit higher, so home affordability goes down a little bit. And if you are kind of struggling financially and interest rates go up, now it's going to be a lot more expensive for you to refinance, because now if you refinance, your monthly payments are going to go up too. Now is the moment that we've all been waiting for, the X factor. These are things that we cannot control and that we cannot predict, right? So government programs, government stimulus, government interference, this is the X factor because we really don't have any control over that. Let's start by looking at the forbearance program, because right now 3.5 million Americans are currently on forbearance on their mortgages, which means 3.5 million households are not making their mortgage payments. Now, what we don't know is how many of this 3.5 million people don't have the means to pay their mortgages, and we don't know how many of these 3.5 million households are just not paying their mortgages because they want to break on their mortgages. We also don't know when this program is really going to end. I mean, the government says that it's going to end in 2021, but the thing about government programs is they never really work the way they say they're going to work. So there's a chance that if lots of people are still behind on their mortgages, we could see this forbearance program extended. I really have no idea. So this is something to pay attention to, and we're really not going to know how many people are actually struggling on their mortgages until this forbearance program actually ends and we start to see how many foreclosures happen. Second, let's consider government stimulus, because what we know for sure is that there are a lot of homeowners that are struggling to make their payments, and there are a lot of tenants that are behind on their rent. Now, we don't know exactly how many people there are, but we know that there's a lot of people that are in that situation. What if the government comes out in 2021 and they say that they're going to bail out struggling homeowners, or they say that they're going to bail out struggling tenants? Well, this is going to completely shift things, because that's going to affect the supply side of things. Because if people who are struggling to make their mortgages are now no longer going to be foreclosed upon and are no longer forced to sell their home, now you're going to see a limited supply of homes again, because a lot of people that were going to be forced to sell their homes, whether it be through the bank or through their own means, are not. Likewise, there's a lot of tenants that are behind on their rent payments. Now, I know I didn't go over that in this video, but you have all these tenants that are behind on the rent that are not being evicted because of eviction moratoriums. So now you have all these landlords who are struggling on their loan payments because they're not getting rent. And so if the government comes in and they bail out tenants, and now you don't have this wave of foreclosures in the landlord side of things, that's again going to limit the supply of homes available for sale, because lots of people that would have been forced to sell their homes for one reason or another are not going to be forced if this bailout happens for tenants or homeowners. Again, are these things going to happen? I have no idea. That's why I call it the X factor, because it's so unpredictable. And this brings me to home credits. Joe Biden says that he wants to encourage people to own a home, and the way he's going to do that is by giving first-time home buyers a $15,000 credit. So $15,000 free to incentivize you to go out and buy a home for the first time. It's free money. If you are a first-time home buyer, now you have all these incentives to go out and buy a home, because the government is literally giving you $15,000 for free to go out and buy a home. So what you'd see happen is this wave of first-time home buyers now entering the market to buy a home. What would that do? Well, that would greatly increase the demand to buy a home, because remember what I talked about earlier, right now first-time home buyers are kind of lacking in the market. So if the government gives first-time home buyers a ton of money to go out and buy a home, now all of a sudden you're going to see an increase in the demand of people wanting to buy a home. The government doesn't want to see a housing crash. It doesn't look good on the president, and nobody wants to see a repeat of 2008. And if you remember, what counts as a housing crash? An increase in supply and a decrease in demand to buy a home. That's why the government would want to create programs to increase the demand to buy a home while decreasing the supply. How would they decrease the supply? By bailing out struggling homeowners, by bailing out tenants. Now, again, I don't know if that's going to happen, but that's potential things that they would do to help limit the number of foreclosures that happen, and they want to increase the demand to buy a home by cutting interest rates and giving people free money to go out and buy a home. So real estate still has a lot of room to grow, especially because we have absolutely no idea what's going to happen in the X factor in 2021. Not to mention the fact that real estate prices don't move very quickly. So when people ask, why haven't home prices crashed yet? You should remember that real estate is not the stock market. In the stock market, when people start to panic and they sell, you will see drastic sell-offs in the same day, in the same minute. In real estate, it doesn't work like that. Real estate moves way slower than the stock market. I mean, it can take 30 days, 60 days, a year to conduct one real estate transaction. It can take a fraction of a second to conduct one stock market transaction. So for the real estate market to crash, that doesn't happen overnight. That is something that takes years to happen. If you enjoyed this video, I linked a video here that I think you'll love, and while you're at it, subscribe to our YouTube channel and join our free finance and business newsletter. And as always, keep hustling. Many people would then ask their banker, what happens if interest rates go up and I can't afford my monthly payments anymore? And the banker would always say something like, well, real estate prices always go up